I want you to filter disinflation into what yield does. Is it just about a demand for paper, price up, forcing yield down?
Well, look, I think that there's a whole variety of things that goes into bond yield determination. The expectations on the Fed and real rates, inflation expectations obviously both very large. I'm in the camp that thinks that we're probably caught in a range. I'm always amazed that people think the 10-year is going to break above 1%, go back to 2%. I don't think that's going to happen. I think that there's still going to be globally a downward pull on Treasury yields because I think inflation expectations, given the size of the output gap, are going to come down over time. And at the same time, if you're taking a look around the world, you take a look at the average AAA yield, it's barely above zero. And in the U.S., you get at least, 70 or 80 basis points. So, it's in the land of the blind, the one-eyed man is king. And I still think Treasuries offer very good value on a relative basis.
David, I think what you're saying is really, really important. It's about the post-COVID world and defining what is normal. And many people seem to think that post-COVID, with a vaccine, Treasury yields have no business south of 1%. You're pushing back against that, David.
Well, I am pushing back against that because, what's your expectation on what the Fed's going to be doing? Ultimately, your forecast of the 10-year yield has to be some scrolled expectation of what short-term rates are going to be doing over a certain horizon. The Fed's already told you that, they're not going to start to raise rates till inflation gets above 2%. Well, we'll wait a long time for that and for us to return to full employment. And that's going to take a long time as well. On top of that, look, there's no doubt that we're going to get a couple of quarters of pent-up demand release once the vaccine is broadly distributed. That's going to happen. Which exactly quarter it's going to happen next year, who knows? But it's going to happen. So we're going to get a couple of quarters of pent-up demand release. And then what does the world post-COVID look like after that? And we never got the inflation from 2009 to 2019, despite all the stimulus, despite the Fed. The reality is that the same thing, the fundamental secular developments, have nothing to do with COVID that brought us to lowflation and low interest rates and low growth. Aging demographics, well, how has that changed? And monumental debts. So you're going to have the Reinhardts on. Well, we'll talk about then, I hope, how these massive run-up in deficits and debts are going to be dealing with those, resolving those. There's going to be a huge constraint in aggregate demand for years to come. How are you going to get inflation out of that? So we're going to get a bump in growth. Bond yields may go up 25, 30 basis points, and then they're going to come right back down again because the same fundamental forces that brought us down 200 basis points on the 10-year note in the last cycle are going to be the same forces that drive yields back down towards zero in the next number of years.